Today, we're going to talk about something pretty incredible. We're diving into some of the absolute star performers in the Indian market, the mutual funds that have just knocked it out of the park over the last 10 years. Yeah, we're talking about a full decade of consistent, powerful growth. So what does that actually look like?
So let me ask you something. Just imagine you put your money into an investment and you watch it grow by almost a quarter, not just once, but year after year for 10 years straight. I mean, it sounds almost too good to be true, right? But for some really disciplined investors, this wasn't some fantasy. This was the reality.
And that brings us to this number right here, 23.8%. That's the compounded annual growth rate, the CAGR, for the single best-performing fund over the last decade. A number like that, over that long a period, can absolutely transform your wealth. So how on earth did they do it? Let's break it down.
All right, first up, we've got the real powerhouses, the aggressive growth engines of the market, the small cap funds. You've probably heard about these because they're the ones that often grab the headlines with just spectacular returns, and, well, for good reason.
So, what exactly is a small cap fund? Well, pretty simply, it's a fund that invests in smaller up-and-coming companies. You can think of them as the rising stars of the economy. They have this massive potential to become the giants of tomorrow, but, and this is a big but, because they're still finding their feet, they also come with a whole lot more risk.
And you can just see the sheer power of this category here. Leading the charge, you've got the Nippon India Small Cap Fund with that unbelievable 23.8% return year after year. Right behind it, you have other heavy hitters like Quant and SBI, both pulling in around 19 to 19.5%. But look at that last column. The risk profile is high across the board. These are definitely not for the faint of heart. They're for investors who have a long time horizon, we're talking 7 to 10 years, and who can handle the wild swings of the market.
So how do they manage all that risk? Well, let's pop the hood on our top performer, the Nippon India Small Cap Fund. You'll see it's not just betting everything on one sector. Nope. The fund is diversified across a bunch of different areas, which spreads out the risk while still letting it capture that explosive growth wherever it pops up. It's a really smart strategy, and it's key to its long-term success.
Now, it's not all about chasing aggressive growth. Not every top performer works that way. Our next category is all about a totally different philosophy, the value-seeking strategists. These are the funds that are all about finding those hidden gems that the rest of the market has kind of overlooked.
A value fund is like a treasure hunter. The fund managers are out there digging deep, looking for really solid, fundamentally strong companies that, for whatever reason, are trading at a discount. The whole idea is simple. Buy them low and then wait for the market to catch on and realize the company's true worth. It's all about long-term patience.
And, well, the results really speak for themselves, don't they? The HSBC Value Fund delivered over 20% a year for a decade. And right on its heels, you've got Nippon India and ICICI Prudential's value funds, both right around that 19.5% mark. Now, notice the risk profile here. It says Med High. So it's a little less bumpy than the pure small cap funds, but still delivering absolutely phenomenal, consistent returns.
Okay, so what if you want a little bit of both? You know, the high-octane growth of those smaller companies, but also the stability you get from the big, established players. Well, that's where our third category comes into play, the balanced axe.
And these are your large and mid-cap funds. They create this really nice balanced portfolio by investing in a mix. You get the large blue-chip companies that provide a solid, stable foundation, and then you get the medium-sized companies that offer that higher potential for growth. It's a strategy that's really designed for a smoother ride. And you can see that this balanced strategy has really paid off. The ICICI Prudential Large and Mid-Cap Fund has just been a fantastic performer, giving SIP investors around 20.5% over the decade. HDFC's fund has also been a really solid choice, returning almost 17%. These funds really prove that you don't always have to take on the absolute highest risk to get excellent long-term results.
Oh, and it's worth mentioning another type of fund that fits in here, the ELSS, or Equity-Linked Savings Scheme funds. Funds like the Quant ELSS Tax Saver have also been really strong performers, and they come with a great added perk, tax savings. The only catch, there's a trade-off. Your investment is locked in for 3 years.
So, we've looked at the top funds, we've looked at their different strategies, but just picking a name off a list is never enough. The real question, the one that really matters, is this. What are the big lessons we can pull from this incredible decade of growth?
Okay,
Let's boil it all down. First off, it's crystal clear that small cap and value strategies were the big winners of the last decade. Second, taking on calculated higher risk really did pay off for long-term investors. A big part of that success was using systematic investment plans, or SIPs, which helped investors smooth out the market's bumps. And maybe the most important takeaway of all is that consistent performance over a decade is so much more valuable than just chasing last year's hot fund. It always comes back to choosing a fund that actually matches your own risk appetite, not just following the latest hype.
Okay, so understanding the lessons is one thing, but actually putting them into practice means you have to avoid the common mistakes that can completely sink your financial goals. So what are the traps you really need to watch out for?
You know, the difference between smart investing and making a huge mistake often comes down to just a few key habits. A smart investor is always focused on the long term. The common mistake? Chasing last year's top performer. Smart investing means matching a fund's risk to your own comfort level. A classic mistake is jumping into a high-risk small-cap fund trying to make a quick buck. And finally, you have to review your portfolio at least once a year. You can't just set it and forget it forever.
And that brings us to what is probably the single most important disclaimer in the entire world of investing, something we have to burn into our brains. Just because these funds were the champions of the last 10 years, that is no guarantee, absolutely no guarantee, that they'll be the champions of the next 10. The market is always changing.
So, as we wrap this up, this is the question I really want to leave you with. The core principles of long-term disciplined investing, those are timeless, but the specific strategies that will lead the pack are always evolving. The real challenge for all of us is to take the lessons from the past decade and use them to build a winning strategy for our own future.